What if the epic run that took Bitcoin past $120,000 wasn't the path to new wealth, but a final warning shot? For months, the dominant narrative has been one of unstoppable momentum and new all-time highs. But what if the charts are telling a different story, a much older, more predictable story that has played out in markets for nearly a century? As of mid-December 2025, with Bitcoin bleeding below $90,000, the market is flashing some serious warning signs. The data is showing what looks like a classic five-wave market cycle completion, a textbook pattern that often signals the end of a major trend. In this video, I'm going to show you the evidence that suggests why blindly hodling right now could be the biggest mistake of this bull market. We're not just talking about a minor correction. We're talking about the potential start of a deep, prolonged bear market that could erase a huge portion of the gains for those who aren't prepared. This is a macro warning, and it's written in the charts for anyone willing to look. To understand where we might be going, you first need a map. In market analysis, one of the most powerful tools we have is Elliott Wave theory. Developed back in the 1930s, this framework suggests that market movements aren't random. Instead, they unfold in repetitive, predictable patterns driven by mass psychology, the natural rhythm of optimism and pessimism. The core of the theory is simple. Markets move in 5 waves in the direction of the main trend, followed by 3 waves of correction. Waves 1, 3, and 5 are impulse waves that push the price to new highs. Waves 2 and 4 are corrective pullbacks within that uptrend. After that 5th wave peaks, the cycle completes, and a much larger 3-wave correction, labeled A, B, and C, begins. That ABC correction is what we call a bear market. Now, let's apply this map to Bitcoin's journey. The entire bull market, from the low in late 2022 to the peak we saw in 2025, appears to have traced out a complete 5-wave impulse structure. The run from the low of around $16,000 in November 2022 to the stunning high of roughly $126,000 in October 2025 looks like a finished sequence. This isn't just a random assortment of rallies and dips. The proportions and psychology of each wave align remarkably well with Elliott's model. We saw the initial skepticism in Wave 1, the healthy pullback in Wave 2, the explosive power of Wave 3, the frustrating grind of Wave 4, and finally, the euphoric, momentum-starved push of Wave 5. If the peak we saw is indeed the end of Wave 5, then the next logical phase isn't another leg up. It's the start of the ABC correction, the bear market. The recent drop from over $126,000 to below $90,000 acts as a major confirmation signal for analysts who follow this methodology. This is the market ringing a bell, telling us the party is likely over. This isn't about being bearish for the sake of it. It's about recognizing a pattern that has defined speculative assets for generations. To make this tangible, let's break down the run wave by wave. When you see it laid out, the argument for a completed cycle becomes much clearer. Our starting point is the bear market bottom in November 2022, when Bitcoin cratered to around the $16,000 level. The sentiment was absolute despair. This was the point of maximum financial opportunity, and it marks the beginning of our count. From there, Wave 1 began. This was the initial hesitant rally that took us from those lows to about $31,000 by April 2023. Many people dismiss this as just another bear market rally, which is classic Wave 1 behavior. It's the wave of disbelief. Next came Wave 2, a corrective pullback that saw the price dip back to around the $25,000 level in the summer of 2023. This wave shook out the weak hands and tested the conviction of early bulls. But critically, it held above the November 2022 low, keeping the bull structure intact. Then came the main event, Wave 3. This is almost always the longest and most powerful wave, and it didn't disappoint. Fueled by the launch of spot Bitcoin ETFs in early 2024, Bitcoin embarked on an explosive surge, blasting to around $73,000 in March 2024. This was the point where the bull market became undeniable. Following that explosive move, the market needed a breather. That was Wave 4. This was a prolonged period of consolidation, lasting roughly from March to September of 2024, with prices chopping sideways. Wave 4s are notorious for being complex and time-consuming, designed to wear out traders and test patience. Finally, we got Wave 5, the last gasp of the bull market. This wave was driven more by public euphoria and FOMO than the raw institutional power of Wave 3. It carried the price to its ultimate peak of around $126,198 in October 2025. Though it made a new all-time high, the momentum was visibly weaker. And since that peak, the price action has been decidedly bearish, with the recent weekend seeing prices tumble to nearly $87,000, confirming the end of the 5-wave sequence for many analysts. If the Elliott Wave count is the map, then the supporting data points are the flashing red lights on the dashboard. Several key indicators began signaling extreme risk as we approached the 2025 peak. First, and perhaps most telling, was the diminishing momentum in Wave 5. While Wave 3 was a story of raw power, Wave 5 felt different. The percentage gains were smaller, and the price had to work much harder to push higher, a classic sign of trend exhaustion. The market was running on fumes. Then we look at the institutional flows. In late 2025, we saw a critical shift. After months of massive inflows, the spot Bitcoin ETFs began to experience significant net outflows. November 2025, for instance, saw net outflows of around $3.5 billion across U.S. spot ETFs. These withdrawals signaled a change in behavior. The relentless buying pressure was easing and reversing into profit-taking. Finally, the most crucial confirmation came from the price action itself. In technical analysis, a break of market structure is the clearest signal of a trend change. The drop from the October high of over $126,000 and the subsequent failure to hold key support levels, leading to the current price below $90,000, is that break. This has been a period of sharp volatility and liquidations, reinforcing the new bearish trend. Each of these signals, weakening momentum, reversing ETF flows, and a clear break in market structure, adds a layer of evidence to the same conclusion. The 5-wave cycle appears complete, and the market is topped. Now, if you're finding this data-driven approach valuable, make sure you subscribe and hit the notification bell. My goal is to cut through the hype and give you the analytical tools you need to navigate these markets. We're all here to protect and grow our capital, and understanding these macro cycles is a critical part of that. So if the 5-wave bull cycle is over, what happens next? According to Elliott Wave theory, a 5-wave impulse is always followed by a 3-wave correction, labeled A, B, C. This is the bear market. This corrective process typically unfolds in 3 stages. The first is Wave A. This is the initial sharp drop from the peak. It feels sudden and catches most people by surprise. Many will dismiss it as a buy the dip opportunity. We've already seen this move with the decline from the all-time high to the current sub $90,000 levels. The second stage is Wave B. This is the bull trap. After the panic of Wave A subsides, the market often stages a convincing looking recovery. It might retrace a significant portion of the decline, drawing in hopeful investors who believe the bottom is in. However, this rally is deceptive and ultimately fails to make a new high. The final and most painful stage is Wave C. Once the Wave B rally fails, a new wave of selling kicks in. Wave C takes prices to new lows, well below the bottom of Wave A. This is where real despair sets in. So, what does this mean for price? Analysts' forecasts based on this structure suggest a prolonged corrective period. Short-term Elliott Wave counts point to immediate downside targets near $80,842. Other models suggest downside risk clustering closer to the $80,000 range. Historically, Bitcoin bear markets have erased 70 to 85% of the bull market's value. While this cycle's institutional backing might cushion the fall, a significant drop is the historical norm. Now, it's crucial to acknowledge the other side of the trade. Some analysts might argue that the 5-wave structure is not yet complete, suggesting that we are in a larger Wave 4 correction before a final Wave 5 pushes to new highs, perhaps over $160,000. These bullish perspectives lean on strong fundamentals. They point to the fact that major players like MicroStrategy are still buying Bitcoin. They also argue that the macro environment, with the Federal Reserve having initiated rate cuts in 2025, should be supportive of hard assets like Bitcoin. However, I find these arguments less compelling right now. The The market's lackluster response to the Fed's rate cuts is a major red flag. Instead of soaring, Bitcoin has struggled, suggesting the market is more concerned with other factors, like a potential slowdown. The character of the sell-off from the peak feels more impulsive than corrective. The failure to hold support and the extreme fear in the market, with the fear and greed index recently hitting a low of 16, align perfectly with the beginning of a new bear trend. While alternative counts are always possible, Elliott Wave is a probabilistic tool, not a crystal ball. The weight of the evidence currently favors the bearish interpretation. The price action, momentum indicators, and shift in institutional flows all point toward a completed cycle. So let's bring it all together. The run from the 2022 lows to the 2025 highs looks like a completed 5-wave impulse cycle. We've seen the warning signs, weakening momentum, and a crucial reversal in the institutional ETF flows that powered this rally. Most importantly, we have a confirmed break of market structure, with the price now well off its highs and struggling below $90,000. This is not a forecast of doom, but a data-driven assessment of risk. The HODL mentality works beautifully on the way up, but it can be financially devastating when a major cycle turns. Every major Bitcoin high in history has been followed by a deep bear market. To assume this time is different is one of the most dangerous phrases in investing. The evidence suggests that the highest probability outcome is that we are in the early stages of a major ABC correction, a bear market that could see prices fall significantly from their recent highs. This is not the time for blind faith. It's a time for strategy, for risk management, and for clear-eyed analysis. What do you think? Do you see the 5-wave structure? Or are you in the bullish camp expecting a rebound? Let me know your thoughts in the comments below. And if you want to see how this correction might play out in the altcoin markets, check out this next video.